is for my intermediate accounting 2 students, accounting 3120. And that is published on YouTube, so they're available to anybody. Maybe people who need a deep sleep can watch me talk for a little while. So I do use the McGraw-Hill Intermediate Accounting textbook, the Spicer, Nelson, and Thomas book. Great book. I want to give them credit because I'm using their materials, but I'm saying that sincerely. I do like the textbook. So with that, I'm going to get started. We're going to talk about bonds payable today. This course is going to start ratcheting up a little bit in terms of level of difficulty, if you will. So I kind of look at intermediate accounting too. Oh, what did I do there? Let me try again. Wrong. I hit the wrong button. I look at this course as like there's a dial, and it starts out medium, not super hot, but medium warm. And we go through the accrual accounting and then bonds payable. We turn that dial just a little bit, and it heats up a little bit. Then we turn it for lease accounting, and then we get to deferred taxes, and we turn that dial all the way to super hot heat. So yeah, so be ready. So I would say this beginning of the course is the opportunity. You should have seen a lot of this stuff in Principles of Accounting. I'm not saying it's easy, but it's easier than what you're going to see coming up in the middle, especially the middle section of Accounting 3120, Intermediate Accounting 2. So bonds and long-term notes. So we're in the long-term portion of the liabilities here. And so these are things that are going to be due greater than 1 year. Unlike the notes payable could have been greater than 1 year, 18 months or 24 months. But bonds could be, long-term bonds, 5, 10, 15, 20-year bonds. The U.S. Treasury sells a 30-year bond. And so they're longer in nature. So there's going to be definitely an interest component. And, most, not all, there are zero coupon bonds, which we'll discuss, but most bonds will pay some interest along the way. What we're going to see, the problem we're going to incur is there is going to be a promise to pay interest at a stated amount, the amount that's listed on the bond. That's a contractual amount that will be paid. In corporate bonds and U.S. Treasury will pay usually semi-annually every 6 months. The problem we're going to run into is that that's not the market rate. That's what's called the stated rate, the coupon rate, the payment rate. The market rate is going to be different. And so we're going to have to value these bonds differently because of the difference between the payment rate, the stated rate, coupon rate, and the market rate. That's another thing you're going to see in this chapter. A lot of terms, that there's a lot of terms for, not just a lot of terms. There's a lot of terms for each item. So the stated rate, the coupon rate, that's a whole set of terms for one thing. For the bond amount, it's stated value, par value, principal. So there'd be a lot of different terms here for exactly the same thing. So they're used interchangeably. All I can say is I feel for you. I empathize. You're hearing this for the first time, but it is what it is. So get used to it, and it'll be good for you as you continue on in business. And I know that many finance students taking this course as well. So why do companies issue bonds payable? Why do they issue any debt? Well, they need funds. I like to use example. We have a lot of restaurant companies like Brinker here in Dallas that owns Chili's and Amagiano's. Chili's started as one restaurant a long time ago, very, very successful restaurant. The Chili's have been around for 25 plus years. And, some of those restaurants here in Dallas are still there. They started out as one restaurant. It was so good, so successful. Tex-Mex was really catching on. They decided to build another restaurant, and then another one, and another one. Now they have Chili's on every corner, near every shopping center throughout the United States. I'm glad because I survived off of Chili's during COVID. They had a really good takeout and a good, process for doing takeout. So they've got to go get funds. Now you can get it in equity or you can get it in debt. Now, when you get your funds from equity, you're going to give up some control of your company. So they're going to have owners. Equity means ownership, right? So you're going to sell some ownership in the company. So a lot of companies, and I'm sure the founder of Chili's would rather get debt. So they're still completely in charge of the company. You know, they own all the equity, but they have debt. Now, most companies, and you'll see in finance, there's some percentages between equity and debt that are the most appropriate for large mature companies. And so companies are moving back and forth between equity and debt. And you see a lot of companies these days borrowing money to buy shares back, share buybacks. And so they're reducing their equity position and increasing their debt position. So again, we're going to talk about this chapter, getting funds through debt, through bonds and through installment notes. We'll go do both of those. And so here, because there is a longer term component, now guess what? We're back to chapter 5. You're going to become experts in the time value of money here. And we're going to have to record these liabilities at their present value, the present value of all future cash outflows. So bonds are a special type of bond. They're sold, can be sold publicly and traded on the, not on the stock exchanges, but traded in bond markets. And, I'm retired, so I have a lot of U.S. Treasuries. So I have to call my broker and say, hey, I want to, buy a bond, U.S. Treasury or corporate bond on both. And so bonds issuing corporation or government, I should add that in there since I talked about U.S. Treasuries. And they're going to have on that bond, so it's a piece of paper. It's, now I've never seen the piece of paper for the bonds I own. The brokerage keeps that, and I guess they're all kind of electronic. But if there was a piece of paper, there's going to be a stated amount. And it's the face amount that will be paid at the end of the bond's life, at the maturity date. So again, another term there, maturity date for the bond. So a 5-year bond issued April 1st, 2022 is going to be mature on April 1st, 2027. That would be the end. And on that maturity date, on that last day, this face amount of the bond gets paid back. If it's a corporation that issued, they're going to pay their investor back that face amount. It'll say $1,000 bond, $1 million bond, whatever it is, that face amount of the bond, that's going to be paid back. And guess what? Here's what I mentioned before. That face amount is called the principal. It can also be called the par value. It can also be called the stated amount, or it could be called the maturity value. I wish I could give you a break and say we're just going to use one term. No, I personally even use these interchangeably. Okay, and then along the way, there's also going to be another comment. So in that bond, it's like a contract between the issuing corporation and whoever buys these bonds. They're going to pay that face amount. So that face amount will be on there, $1,000, $1 million, whatever it is. And settlement date, maturity date, very end of the bond, that's going to be listed there. And the interest rate for this bond. And then how often the interest is going to be paid. Usually for corporate bonds and treasuries, as I said, it's semi-annual, twice a year. But there's going to be a rate there. You could say $1 million, 5% bond due in April 1, 2027. That's how you would actually talk. Hey, it's a 10% bond or 5% bond. So that interest rate is what's listed on the bond, and that's how much is going to be paid. Nothing else paid. It's going to be a different rate. We're going to talk about the market rate. That's how much investors want to earn, but that's not how much you're going to be paid. They're going to be paid the interest rate. Okay, guess what? That interest rate that's listed on the bond, it has different names, and they all mean exactly the same thing. There's no difference. It could be the stated rate. That makes sense. The rate that's stated on the bond. Coupon rate or nominal rate. All three of those are same terms for one thing. That's the stated amount on the bond. That's how much will be paid. Contrast that to what we'll see later, the market rate or the yield. That's something different. That's not on the bond. That's what investors want and what investors expect to earn on the bond. And so we're going to see that market rate could be different than what they're paying. And that's going to create some issues around the value of the bond. So the value we're going to see is going to be less or greater than the face amount, even the first day it's sold. How many kinds of bonders? This is just a few of them. There are many. Debenture bonds are, secured by the full faith and credit of the whole corporation. There are no specific assets, pledges, securities. Investors have the same standing as other. So debenture bonds. Mortgage bonds, conversely, they are backed by specific real estate. So if a company did not pay back a mortgage bond, then the bondholder would own that real estate. Here, if the company could not pay back the debenture bonds, they would have to go after the whole corporation. The corporation would have to declare bankruptcy, and then everybody would stand in line to get their money. Mortgage bondholders are a little safer because they say, hey, we don't worry about that. Just give us our real estate. We own that real estate now. So it gets, by the way, in a bankruptcy, there's a lot of competing people who want those assets that hold debt. And all debt holders stand in line first in liquidation before equity holders. Equity holders means people who own common stock. They're at the greatest risk. Most likely they're going to end up with zero. So you don't want to own a company that has a chance of going bankrupt. Convertible bonds, hey, this could have it's in between. It's a bond, but I could convert that bond into shares of stock. So, and by the way, convertible bonds will have a lower interest rate because there's that option to convert those into shares of stock. And so that's why companies will issue convertible bonds, because they want to have, lower interest rates. Callable bonds, this is something where companies have the option to call the bonds all in. Hey, we're going to pay them all off now. 5-year bond, end of year 2, we're calling them all in. Why would a company do that? Let's say they're paying 5% on these bonds, but interest rates have gone down to 2%. Well, I don't want to pay 5% anymore. They're going to call all the bonds in. So when you buy a bond and you're expecting to get 5%, you better make sure it doesn't have some calling features that may result in you not getting that 5%. And so there's a lot more terms, yield to worst. There's a lot of different finance terms around bonds that have callable features, which are kind of interesting. And then serial bonds are nothing more than they're going to be issued in installments. So the company may have 1-year bonds, 5-year bonds, 10-year bonds, like on the same day. So serial bonds. Again, not going to really hold you accountable for all of this, but here you go. Here's where the core, meat of this chapter is right here. So the stated rate, also called the coupon rate or the nominal rate. Keep in mind that stated rate is coupon rate, nominal, all the same thing. That refers to one thing: how much the company is going to pay off that bond. And how much are they going to pay? It's going to be the stated rate times the face value, which means also par value principal. So that all comes right from the piece of paper that is the bond. And it will tell you what the face amount of that bond is and what the coupon rate is for that bond. The amount that will be paid is that coupon rate times the face value, regardless of what the price of that bond might be in the marketplace or whatever else. The market rate, it also has 2 names. Love that, don't you? Market rate or the effective interest rate. That is the rate that this particular bond should be paying at in the market. It's not. It's going to be paying less, more. It could be paying, like in this case, it's paying exactly the same amount. So that's kind of interesting. That's just coincidence. Really never happens in practice. There's always some kind of difference between the stated rate and the market rate. This is also called the yield of the bond. So market rate, effective interest rate, yield of the bond. So if in a very rare case, the stated rate, which will never happen in this class because I'm always going to have differences, this would be too easy. If the stated rate and the market rate are the same, means the company's paying the market rate, then the value of the bond will be the face amount. There's no issue there. However, if the bond is only paying 12%, the stated rate's 12%, but the market rate's 14%, oh my God, we're kind of shorting the market. We're not paying them their full due. Well, first of all, you'd never be able to issue that bond if you expected to get the face amount like you would in this case. You're going to have to sell that at a lower price. And guess what? In principles of accounting, we just gave you that lower price, and you could do all the accounting from that. Not here. You're going to calculate it, and we're going to, use time value of money, and we're going to use this for the future payments, the annuities. But this is going to be the discount factor. This is what we're going to use to the I in the time value of money, the interest rate that we're going to use to calculate the present value. So the price of this bond is going to be the present value based on this 14%. But notice here, if you're paying less, then it sells at a discount. Now, conversely, if you're paying more, which can happen, you are paying 12% rate, but the market rate is only 10%. Then you can sell this for more at a higher price, at a premium over the face value. Again, we're going to, hopefully you'll see this a little more clearly. I think this is very logical. You pay less than the interest rate and the market wants. You sell your bond for less than the face value. If you're willing to pay more along the way for the bond, even though the market rate is lower, you're paying more, you get to sell your bond for more. It's a direct relationship. I think that should be logical and fairly easy. And how does the market determine the interest rate? Well, it's based on risk. The risk meaning what? Are they going to pay us back? The stated amount. This is a promise. And if you buy a 10-year or 20-year bond, a lot of things can happen over 20 years. General Electric was a very highly rated, low risk bond. Not anymore. It's junk. General Electric bonds, they're not AAA anymore. And so their market rate is going to be higher than it used to be. And so these companies, S&P and Moody's, they rate bonds, and they go all the way from D, pure junk, near default, CCC. This company is probably going bankrupt. These bonds and this rate, CCC, they'll go at 10 cents on the dollar. And people will buy them because maybe they want the assets, but they were hoping the company will go bankrupt. Here at AAA, very high risk, meaning almost as safe as the US government. One company, I don't know how they're rated today, but I know in the last year or two, they were rated AAA, Johnson & Johnson. Very, very safe company with the, all the different kind of products they sell. Great cash flows, AAA. Now they've had some issues and there's been some litigation, contingent liabilities out there. Maybe they're not rated AAA now. So these companies rate. And so if you're higher rated, means less risk, then you can go out and the market interest rate will be lower. If you're high risk, the market interest rate is going to be higher. And these are, rated here are called junk bonds. And up here are investment grade bonds. So how do we determine the bond price? It's nothing more. We did I did the time value of money chapter problems. And the last one I worked and I asked you guys to do a bond payable price calculation. And all it is the present value of that annuity of the principal. And whenever that date is, if it's a 10-year bond, we're just going to look at the present value of that face amount in 10 years back to today. And then we have to do another present value to add to that all the cash payments that will be made along the way. How do we come up with those cash payments? It's the stated rate, the coupon rate, the nominal rate, times the face amount, or the par value, or the principal. I feel sorry for you because there's so many terms, but if you learn them, it'd be good for you because you need to know this as business people. And so discounted at the market rate means that's the interest rate we're going to use. We're going to use the market rate as the interest rate in the time value of money calculation. And ultimately, bond prices say in terms of percentage. And I think, this is all credit to finance people, just makes it easy. So, you have $1 million bond or $1,000 bond, whatever. A price of 98 means it's 98%, it sells at 98% of the face value. Mean, by the way, that means they are paying, the coupon rate is less than the market rate. Now, a bond priced at 101 means it would sell for 101% of $1,000, 1,010, and that also tells you right away if the market price is higher than 100, means it's selling at a premium, means our payments that we're making for coupon rate is higher than the market rate, which is the yield. Okay, here's an example. This is a $700,000 12% bonds dated January 1, and interest of $42,000 is payable semi-annually on June 30th and on December 31st. By the way, they were nice to give you the $42,000. I would never do that in any problem you see from me. You got to calculate that. I would say the bond is interest is payable semi-annually, period. And then you'd calculate that. You say 12% times 700,000. That's how much they're going to pay. That equals 12% of 700,000 equals 84,000. How often is going to be paid? Twice a year. So we're going to pay 42 of it in at the end of 6 months, and 42 at the end of the second 6 months. By the way, I just said end of, right? So is this going to be present value of annuity due or present value of an ordinary annuity? Payment at the end, ordinary annuity. So when we use our tables, we're going to use the present value, the PVOA, present value of an ordinary annuity to calculate this. And so here they've done that for you. So the interest is 42,000, and how many payments? Let's see, they're going to make. It's this issue payable. The bonds mature in 3 years. So this is a 3-year bond with payments twice a year, means compounded twice a year. So the N is going to equal 3 times 2 equals 6 for both of these calculations. And the I is going to equal, again, we don't use the 12% for the I. That's the 12% calculates the payment amount, the 42,000 plus 2, 84,000. We discount the I comes from the market rate. And you could think about that, but what's going to happen is this bond is going to earn the market rate. Now, how is it going to do that? By selling for less. The price will be less than 100. Less, it will be sold at a discount because we're, therefore to allow in mathematical terms, in finance terms, the bond to earn yield 14%. So we're going to use 14% as the discount factor. What is compounded, that's the annual rate, divide by 2, we're going to use 7%. Oh, go back. 7%. So we've got 2 things going on here. One is an ordinary annuity. And so that's that 42,000. There's going to be 6 payments of 42,000 over these 3 years. And discounting it at I equals 7%. I come up with my factor, that's 4.76654. In other words, the present value of all those 42,000 payments is 200,000. But that's not all that the investor is going to receive. That's not all Masterware is going to pay. They're going to have to pay 700,000 at the end of 3 years, compounded semi-annually. And so we can do the present value of that. And that's N equals 6, I equals 1. That factor is 0.66634. Back to our time value money. You're going to have to know time value money or you will fail this next exam. That's it, yeah. And so the time value money is 700,000 times 0.66634 or 466,438. Add the 2 together. So the face value of this bond or the principal or the par value is 700,000, but it's not going to sell for 700,000. It's going to sell for 666,000. So the company is going to receive less than 700,000. They're going to receive day one, 666,000. But on the very last day, the last day of the 3rd year, they're going to pay 700,000. What is that 34,000? What does that represent? That's interest. Remember, time value money calculations, the difference between that future value of 700,000 in today's value, that's all about interest. And so that $34,000 is interest. But what you say, hey, but we are paying interest. We're paying $84,000 of interest every year. Why do we have another 34,000? It's to make up the difference between 12% and 14%. So now, the way this works mathematically, the investor pays out $666 now, gets $700,000 later, and they get 12% payments only. Guess what? They're earning 14%. Mathematically, they're earning 14%. So they're willing to buy this because they, bond investors are really good. I put myself in that camp with time value of money. They understand it very, very well. And, they wouldn't want to be stupid around it, right? And so, again, I spent a lot of time on this slide because this is kind of the core of this chapter. The problems that you'll work on any exam, probably in any classroom, going to come out from here. And so now we got to do all the accounting for this. So look at the way this works. This is the cash inflow, 666 for the company, and here's all the cash outflows, 42,000 6 times over 3 years, and then got to pay 700,000. So now let's go look at the journal entries that you're just going to love, And so journal entry 1. By the way, I'm not going to do the investor side here. I'm only going to focus on the issuer. And for my intermediate 2 class, I'm only going to test this for the issuer, not the investor. The investor is the same math, but there's another chapter on investments, and I will cover that then, not now. So for the issuer, they get that price. They're going to receive debit cash, 666, 633, and that's to fund their operation. But we got to handle this bond now, and this is the way we do it. There's probably been other alternative ways to do it, but this is the way it works in accounting, and it does make it easier. We're going to put that face value in the bonds payable account, and we will never touch that account until we pay that bond off at the end of the 3rd year. But this difference between 666, we're going to put in the discount. We call this is a new account, discount on bonds payable. It's the difference on this price. We'll see later, if we sell the bond for more than 700,000, we'll have a bond premium account. They're very, very similar, but one is for when the interest rate we're paying is less than the market rate, and the other one's when we're paying, a higher rate. So this discount, we're going to deal with this over time because we're going to have to amortize this discount down to 0. So that at the end, all we're going to have is just bonds payable, and then we'll, credit cash, debit, bonds payable. So this amount here, we're going to amortize, kind of like you would do an asset in depreciation, but it's going to be different because we're going to use the effective interest method. You might, in our principles courses at UNT, we just straight line this. So we would divide that by the 6 payments and straight line it. By the way, I'd always cringe when I teach that in principles because it's not allowed by GAAP. The effective interest method, which you're going to learn now, is required by GAAP. But again, the goal is to take this down to 0. And again, what is this? Boy. What does this amount represent? Interest. So we're going to amortize this into interest expense because we only received 666 and we got to pay 700. So that is interest over 3 years. So, each accounting period, each year, we got to record, it would be on a straight line basis, about 11,000 a year. We're going to credit, discount, debit, interest expense. And we'll see. But we don't do it in a straight line method. You so wish. So here's the effective interest method, how we do it. We look at the outstanding amount, every accounting period. So for the very first journal entry, the 666, that's how much is net. That's how much we receive. That's our true obligation. One thing just to note here, let me do that. this, we call this account, it's like a contra liability account. The amount that we show on the balance sheet for the bonds payable, if this is our only one, would be 666, 633. We would net these two items together. But we track them separately back in our accounting systems, in our journal entries, so it makes it easier to do the amortization. Okay, so how much is the real interest expense for that first 6 months? Well, we look at the amount that we received, the amount that's outstanding at the beginning of the accounting period, and that's 666, 633, and we multiply that times the effective rate. What's another word for the effective rate? The market rate or the yield. So we'll just use effective rate here since we're doing the effective interest rate method. And that is annual rate 14%, but we're only talking about 6 months, so we divide it by 2. So 666, 633 times 7%. That's debit interest expense for that amount. That is the real interest expense, and that is the market rate. But we have a little problem here because guess how much we paid? We paid only $42,000. So we're going to credit cash for $42,000, debit interest expense for $46664. No, debit interest expense for $46,664. Remember that back here, and we're going to credit cash for $42,000. That's how much you're paying. So that difference is going to be the amortization. We're going to reduce. It's going to be a credit to the discount on the bonds payable. By the way, now that discount amount has changed, and so our outstanding balance has grown. We'll see this. We might see this better when I work the problems. I do a few more columns than this. With this show, yeah, this is a little bit, yeah. So, in other words, the discount account has gotten smaller. It's not 34,000 anymore because we took a credit to it. We amortized it down. And so now it's about 29,000. And so the outstanding balance is 700,000 minus the current balance of the discount account, 671, and then we go calculate interest expense times that. And so each time, and you see how interest expense is growing because this balance is approaching 700,000. Now, why is it approaching 700,000? It's because we're reducing with credits that discount account we set up. In other words, it started at 33,367. They don't show it here, but it's going to go to 0. This whole 33,367, this is how we amortize it down until it became 0 at the end. Maybe you'll see this better when I work this myself. In the second lecture for this chapter, I work and do amortization tables, which I will expect my students to do on an exam. All right. You could also sell bonds that have no payments along the way. They're called zero coupon bonds, and they would be sold at obviously a deep discount from the face amount because they never pay any interest. So you still record interest expense for tax purposes, they say here, and we will record interest expense in accounting as well, but I won't get into all of that. Okay, here is the same thing that we just looked at for discounts, except it's the opposite scenario. These bonds, the same 712% bonds, but the only thing that changed in this problem is the market rate is 10%. So we're paying more interest than the market. Again, we're going to discount this back at the 10%. We're going to pay 700,000 times 12%, 84,000 a year, twice a year. So 42,000 every 6 months. That's the 84,000, 12% times 700,000. Let's say it again. And then that's the payment amount. So that's an annuity of 42,000. What's changed here? Because all these things are the same as we had in the discounts, Well, guess what? The discount factors have changed because we still have N equals 6. We still have an ordinary annuity, but the I is 5%. Remember, that was 7% when we're looking at a 14% market rate. Again, why is it 5% versus 10%? We're compounding it semi-annual. There's 2 periods in each year. So we 3 years times 2 payments a year equals 6. 10% divided by 2 payments per year, interest rate equals 5% for each of these ends. Again, taking all the present value, hey, lo and behold, look at this. The value of that bond is $735,000. So guess this is interesting. The company is going to like this up front because they're going to get more than their face value. The company is going to sell this bond for $735,000. That's the good news. The bad news is they're going to be paying higher interest rate than they needed to. And so think about it from the company's viewpoint. I think about this as an investor's viewpoint. Do I want a higher coupon rate along the way, knowing that I'm going to have to pay more for it up front? So the investor had to pay more for this. They had to pay a $35,000 premium, knowing they're going to get 12% versus 10%. Now, what is the difference between 735 and 700? It's interest again, except it's a reduction in interest because we're overpaying the interest. This ends up in a reduction in interest expense. So interest expense will be lower than amounts we're paying. Remember, in the discount bond, that interest expense, $46,000, was higher than the $42,000 because we had to take care of that $34,000 discount. Now we've got a $35,000 premium. It's going to reduce interest over time, but the same thing's going to happen. We're going to take this to 0. The only difference here, this thing is so sensitive. The only difference here, we're going to use a different account name. It's no longer a contra because it's going to add to the bond. And we call this premium on bonds payable. So at any point in time, if you want to know what's the outstanding balance of the bond, which you'll need to calculate the interest expense, you'll need that in this class. In this case, you would add the 2 credits. The outstanding balance is 700 plus 35,000, or 735 would be the outstanding balance. Let's go back to that other slide. Here, we got a credit of 700,000. This is the discount on the bonds. And I subtract a debit. You think about this from debit credits. What's the total credit? 700 minus 33, or 666 is the outstanding balance. So it's the opposite effect here with a premium. Now we're going to do the same kind of work. We're going to go calculate off of our outstanding balance. Step 1 is calculate the interest expense. Interest expense is 5% times 735, 36,677. Look at this. We overpaid 42,000. So we're going to credit cash for 42,000. But we're going to debit interest expense for 36,000. And we're going to debit the bond premium for that difference. Remember, we start with a credit of 35,533. And we're going to debit it by 5,000. So now it's going to be $5,000 less. And look, the outstanding balance changes. You can see 700 plus 30,000, not 700 plus 35. And each accounting period, you go through step 1, calculate the interest expense times the beginning of the period outstanding balance. Outstanding balance. I'm going to say this one more time. Outstanding balance. It works the same for premium or discount. The outstanding balance equals bond payable account minus the discount account in a discount situation. Here, it's the bonds payable account plus the premium. And if you want to think of it, they are both credits. That helps you think about it. And all along the way, we're going to do this math. The outstanding balance is going to change. Guess what? Just like the discount accounts, it's going to approach 700,000 just from the other side. And these amounts are, reducing that premium down to when it's 0, and the outstanding balance is 700,000. Goes to 0 on the very last day. So what's left in our account? $700,000 bond payable, and then we pay it. We pay the principal. debit bond payable for 700,000, credit cash for 700,000. Easy peasy. Again, this is kind of a big deal. All students have to go through the hurdle of learning this. It's a bit challenging. I think it's if you work this many times, work the examples, and when I do my lecture and work the problems, you want to pause that video and work it. If you work it, you'll get it. You work this and you do the journal entries, both. And I will require my students to do both on an exam. Okay, so that's it for bonds payable and all of that. But now we've got to deal with some extraneous issues around it. When we issue those bonds, there's going to be legal and accounting fees and printing costs. There is a lot of work. You got to file if they're publicly sold bonds. You got to file them with the Securities and Exchange Commission. You've got to do an offering memorandum. You got to, there's a whole bunch of filings, let's put it this way, that the Securities and Exchange Commission requires before that you can do this. If you're, especially if you're selling in public, but there are always going to be accounting fees. A lot of lawyers are going to get involved. Investment bankers for you finance students get heavily involved in this and help us, sell the bonds. And so there's going to be costs. So what do we do with those costs? We just we combine it with the discount of the premium. So they would reduce the premium, because that starts with a credit and these are debits, right? Or it would increase the discount to debits. And so we have a discount in bond premium. And then we amortize that using the effective interest method. It's just a different balance. Okay, now we're going to talk about long-term notes, notes payable, and notes receivable. But the primary piece here is installment notes. Now, the difference in installment note, the biggest difference is there's no payment at the end. And there's no market rate or just stated rate. It's going to be whatever rate you use, you're going to calculate the payment. What are some good examples of installment notes? Car payments, if you're making car payments, mortgages for houses, those are installment notes. So you're going to do payments of equal amounts. And so we calculated some of these in the time value of money chapter, but now we got to do the accounting for it. And the big issue here is that each payment has two components. One is an interest component, and the second piece is a reduction in the principal amount, the amount that you owe. And this happens in any installment note, so that towards the end, you have to get to the end where you owe zero. The only way you do that is this payment is going to have interest expense and it's going to reduce the amount you owe. Here's an amortization schedule. Again, I will work this again for you, but like the other one, these are semi-annual payments of 139,000. So we're making $839,000 in payments. Now, guess what? This must be I don't have the problem here. This is a 14% interest rate, I can tell. And so the value is 666. So the company has a note for 666. And well, they don't have a note for anything. They have a note that says one thing: pay us 6 installments of 139,000. What's the present value of that at 14%? 666, 603. 14% compounded semi-annual. So of this $139,000, now let's look at this. So the outstanding balance is 666. This is like the step one from bonds payable. You take 14% divided by 2, 7% times the outstanding balance. So the interest is 46,664. But we paid 139,000. So what does that do? That the difference between these, that reduces how much we owe. This is if you ever want to say I'm like got a 4-year car loan, you're end of year 3, you want to trade your car in, you go look at your outstanding balance of your loan. That's what this is right here. Exactly. And it goes down to 0 at the end, and it reduces. Now it reduces slower in the beginning because you have bigger interest in the beginning, because bigger outstanding balance. So 7% of 666 is a lot less than 7% of 130. in this case. And so they work magically right down to zero in our work of installment loan problem when we do the problems for this class. So here, the journal entry 666, 633, the very first one, journal entry. And then here, I'm only going to do it from the borrower side, not the lender side. So there's our interest expense that we calculated. And now we're reducing the notes payable, credit the cash amount. And so that's why that notes payable, that outstanding, we don't have, fortunately, thank the Lord, we don't have a discount or premium on this. We just take and directly reduce the notes payable over time. And there's no market rate versus stated rate here. So it's far less complex, but that's why I love bonds payable. That's why I will test you on bonds payable, because I want you to be critical thinkers on this. Lots of disclosure around liabilities. If I see a big company with big debt, I was looking at Verizon not that long ago, ungodly amount of debt. And I was very interested in the company. I want to make sure they're going to pay dividends. So what I want to look at is, hey, what's the maturity dates for this debt? And most of it was out much further. And so I felt like, well, they're not going to have any short-term issues. Just keep selling those iPhones and selling plans, and you keep generating cash, and they actually are trying to reduce debt. So you can go to the footnotes. When we say financial disclosure, that's in the footnote. And so the footnotes will have a lot of information about the debt. In a balance sheet, you just have one number. Well, I want to know a lot more. I got to go to the footnote, and I can see what are the interest rates, maturity, are there call provisions there, what conversion options, or I have assets been pledged as an investor I would care about. I mean, the devil's in the details. I think I kind of wish at UNT we'd have a whole class just on footnotes. That would be crazy hard, because the rules are hard. And that was, as a chief accounting officer, that was hard for me. I had to make sure I disclose everything. I would not have a favorable audit opinion, even though my balance sheet and income statement were perfect, if I missed something in the disclosure. So disclosure matters. Now we could extinguish the debt early. Maybe we call it, and we've got to call the debt in. Well, guess what? Here, you could have a gain or loss. This is the point of this slide, and I may have a question on the exam like that. So here's how I would think about it. Whatever is out there, whatever you call it for, you're going to pay cash. So the cash amount. Then you also know what is the discount on your book. So you're going to credit that. And then you're going to debit the bonds payable. And then I'm going to see, do I need a credit or do I need a debit? In this case, I've got I've got 708,000 here, only 700,000. So I need a debit. Therefore, it's a loss on the extinguishment of debt. If I had 700,000 and these added up this 650 or something, I would need a credit. That would be a gain. So I would kind of look at this as, what plug do you need to get the right answer? Again, where do these numbers come from? Cash, that's how much we got to pay. That'll be given to you. And then you got to know what is in your discount on bonds payable account. You know what's in your bonds payable account. You just do the, if I got a credit, bonds payable is a credit, so I'm going to put a debit there for 700,000. Discount on bond, that's a debit balance. I'm going to put a credit there. And then, so I know the balance of these two accounts. And so I wipe them out to zero. Then I look for whether I need a debit, meaning it's a loss, or credit, meaning it's a gain on extinguishment of debt. Now, this is different. Detachable stock purchase warrants, a lot of students do miss this. It's just one slide, couple of paragraphs to your textbook. And I do test this many times because I want you to get into the nuances as well. Separate the A's from the B's, if you will, in class. And so a detachable stock purchase warrant is different than a convertible bond. A convertible bond, the whole bond converts into stock. Here, my bond stays intact, but I have these, you have this warrant. I can go out and exercise at any point in time and buy stock at a certain price, maybe a good price. Well, the issue here is you really have two things in one. You have a bond and you have a stock option. There's two things. And so the accounting rules require you to separate them out. And the value of those issue price is allocated between the two different securities based on their fair value. And so that's important. If bonds are issued between interest dates, there is going to be accrued interest on the terms of the buyer or the seller. So, I look at that. I'm going to buy bonds with some accrued interest, meaning that interest has already been accrued. That's already part of the price of the bond, and that's what I'm going to receive as an investor. So, and that will be between interest dates. And that's the end of the lecture slides. Again, I think this lecture it's really important to watch me work the problems, and you also work the problems, which will be in the next lecture for chapter 14 here. So this is the 14A lecture, and it'll be in the 14B lecture. All right, thank you guys. Hope you have a great day.